On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. World shares have hit fresh record highs in recent days, defying forecasts for a pullback and looking much stronger than many predicted just a few months ago. The MSCI All Country World Index is up 13.2% in 2025, and it's more than 40% higher over the past 2 years. I should note that we haven't seen the same strength here in New Zealand, with the local share market down slightly in 2025 and still 16.6% below its record high from early 2021. I'm excluding dividends when I do those calculations. The lagging nature of domestic assets, and it hasn't just been shares, it's also been residential property, commercial property, that's a story for another day. However, when it comes to global shares, the bull market is absolutely back on. Let's talk about 5 reasons why investors are in such good spirits. Number 1, corporate earnings have been beating expectations. The international reporting season for the June 2025 quarter is close to wrapping up now, and the results we've seen over the past 3 to 4 weeks have been impressive. With some 90% of S&P 500 companies in the US having already reported, more than 80% have exceeded earnings estimates. More importantly, the aggregate earnings growth rate compared to the same quarter a year earlier was 11.8%. That's well above the 4.8% that was originally expected, and it's the third consecutive quarter of double-digit earnings growth. Reason number 2, markets have grown more confident the Federal Reserve in the United States will resume its easing cycle soon. The Fed meets next month, and investors are hopeful about a potential interest rate cut at that time. US inflation was softer than expected in July, prompting this renewed optimism, and while there was evidence of tariff-induced price rises in some categories, it wasn't significant. Right now, the upper bound of the Fed funds rate, remember the Fed sets a target range rather than a specific rate, like with our OCR, the upper bound of the Fed funds range is 4.5%. Now that's down from a peak of 5.5%, although it hasn't changed since late last year. Markets are now hoping for a 0.25% rate cut at the upcoming meeting and 3 more by the middle of next year. That would be a positive for the US economy, for borrowing costs, and for risk assets like shares. Reason number 3, the AI trade has come back with a vengeance. Back in mid-April, the so-called Magnificent 7, and I know there's people out there saying it's now the Magnificent 6 or the Magnificent 3 or whatever, but I'm a traditionalist, so I'm going to keep calling it the Mag 7. The so-called Mag 7 had slumped 25% back in mid-April after Liberation Day, while the other 493 stocks in the S&P 500 index were down just 10%. They had held up much better than the Mag 7. The AI trade looked to have done its dash for the time being, and it appeared that this dominant part of the US market would hold US shares back over the coming months. However, sentiment has flipped since then, in part due to some exceptionally strong earnings releases, as well as newfound confidence that this theme will continue to drive economic growth and productivity gains. Since April, the Mag 7 basket is up more than 50%, while the other 493 have struggled to keep pace with just a 22.6% gain. I say just, that's still a fantastic gain, but it really has been the tech stocks, the AI exposures, and that Magnificent 7 that have done very, very, very well. Number 4, the global economy hasn't fallen apart. Yes, the US labour market has softened and Chinese indicators have been mixed, but it's a slowdown that we're seeing rather than a collapse or a recession. Meanwhile, economic growth has actually been stronger than expected in Japan and in the UK, while investors are getting increasingly upbeat on the prospects for Europe. Europe is looking more unified and integrated these days, while fiscal policy, largely driven by German stimulus, is becoming more accommodative. While the US market gets a lot of the attention, some of the biggest gains in 2025 have come from emerging market shares, which are up 18% so far this year. The United Kingdom, with the FTSE 100 up almost 12% this year, and from Japanese shares, which are also up almost 12% this year. Last but not least, tariffs and trade tensions look to be past the worst. US tariffs will be a headwind to growth in the world's biggest economy, while they'll also put upward pressure on inflation. However, at least we know where we stand now, for the most part, and we can plan for life after Liberation Day. The average US tariff rate has jumped to the highest in decades, but most countries have ended up with an outcome better than the worst case scenarios. The situation with China remains unanswered, but hopefully the second 3-month extension of 2025 signals a constructive relationship and maybe some potential for a better than expected outcome. US midterm elections take place in 2026, and that will see all 435 seats in the House of Representatives and 35 of the 100 seats in the Senate contested. One would think that President Trump and his Republican colleagues will want all of this tariff talk to be well and truly behind them as we head into this period, and they'll want the focus to have shifted to more positive themes such as tax reductions and deregulation. So is this recent strength justified? Well, the global economy is proving resilient. Corporate earnings are strong. Inflation does remain well contained, and we're likely to see interest rates come down steadily in the months ahead. Bumps along the road are inevitable, but that's still a recipe for solid returns. Markets are choosing to look past the political noise, concern over rising valuations, and the usual list of things to worry about, and they're choosing to focus on those positives. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.